All right, let's dive right in. We are going to tackle something that can feel, well, a little intimidating. Your very first investment portfolio. Our goal today is simple, to turn this whole concept from a complete mystery into a master plan that you actually get.
You know, if you've ever listened to financial news and felt like they're speaking a totally different language, you're definitely not alone. All that jargon, equities, fixed income, asset allocation, it can feel like you need some kind of secret decoder ring just to figure out what's going on.
So, that brings us to the most important question of all, the one we're here to solve. What on earth is an investment portfolio anyway?
And here's the good news. The answer is way simpler than you think. A portfolio is just all the financial stuff you own, all gathered in one place. That's it. The best way to think about it is like your own personal financial toolkit, filled with everything you need to build wealth. It's not some complicated black box, it's a box of tools.
So, let's run with that idea. Your financial toolkit. We're going to open it up and see how we can go from all that confusing jargon to a really simple, really powerful concept. Okay, so if it's a toolkit, you're probably wondering, what's actually inside? What are the tools we get to work with? Let's take a look at the essential building blocks.
In pretty much every investor's toolkit, you're going to find these four main things. You've got stocks, which you'll also hear called equities. You've got bonds, sometimes called fixed income. Then you have things like mutual funds and ETFs. And, of course, you've got good old reliable cash.
Now let's zoom in on the two biggest players here, stocks and bonds. Think of it like this. Stocks give you a tiny piece of ownership in a company. They're like the power drill in your toolkit. They have a ton of potential for growth, but they also come with more risk. Bonds, on the other hand, are more like the level. They're basically a loan you're giving to a government or a big company. The returns might not be as exciting, but they bring some much-needed stability to the whole operation.
So what about those other tools? Well, mutual funds and ETFs are amazing. They're kind of like those pre-packaged tool sets you can buy. They're baskets that hold tons of different investments all at once, so you get variety right out of the box. A super popular type is an index fund, which just copies a market index, like the S&P 500. And cash? Cash is your Swiss Army knife. It's there for emergencies, and it's ready to go when you spot a great opportunity.
All right, so we've got our tools laid out on the workbench, but how do we actually use them together? This brings us to what might be the master rule of building a portfolio, the incredible power of diversification. I guarantee you've heard this a million times, but when it comes to investing, don't put all your eggs in one basket is so much more than a cliche. It is, without a doubt, the golden rule for managing your risk.
And here's exactly what that looks like in the real world. It's a balancing act. Say your exciting tech stocks are having a rough patch. It happens. Well, the good news is your boring but steady utility stocks might be doing just fine, chugging along and paying out dividends. Or what if the whole stock market hits a slump? That's when your bonds and cash can really shine, acting like a safety net and holding their value. See? The key is that you're never counting on one single investment to do all the heavy lifting.
Okay, enough theory. I think it's time to make this a little more concrete. Let's see what a real portfolio actually looks like in action.
A really common, classic starting point for a lot of people is what's known as the 60-40 portfolio. And the strategy is brilliantly simple. You put 60% of your money in stocks, that's your growth engine, and the other 40% goes into bonds for stability.
And here it is visually. Super straightforward, right? That bigger 60% slice is designed to grow your money over the long haul. That 40% slice is your shock absorber, there to help cushion the blows when the market gets bumpy. It's a strategy that's all about trying to capture some of the market's upside while protecting you from the worst of the downside.
Now let's get even more specific. Imagine Sarah has $10,000 to invest. Look how she's diversified within the 60-40 rule. Her 60% in stocks isn't just in one thing. It's split between big US companies, smaller ones, and even international stocks. That other 40% isn't just one bond either. Every single piece here has a specific job to do, creating this really well-rounded financial team.
So you did it. You built your portfolio. You're all done, right? Well, not quite. The last and maybe most important part of the puzzle is keeping it healthy, and that's an ongoing process.
Okay, there are 3 keys to making this work for the long run. First, you've got to know yourself. Figure out your personal comfort with risk. Second, based on that, you decide your asset allocation, that perfect mix for you. And third, this one is so important, you have to rebalance. See, over time, some of your investments will grow faster than others, and your mix will get out of whack. Rebalancing is when you step in, sell a little bit of what's done really well, and buy more of what hasn't. It feels weird, but it's an incredibly powerful way to stay on track and keep your risk level right where you want it.
So, if you only take away one single thing today, please let it be this. A portfolio isn't just a random pile of investments you hope will go up. It's your personal blueprint, your own strategic plan designed to perfectly balance risk and reward over time.
And that's a wrap. Look, everyone's financial journey is going to be different. That 60-40 plan we looked at, it's just one example out of countless possibilities. So, the real question I want to leave you with is this. What tools are you going to put in your financial toolkit?